Today, I will explain treatment of provision for tax. Okay, let us take example in balance sheet provision for tax 2015 as well as provision for tax 2016 balance will be given, and in adjustment income tax paid during the year will be given. In this example, I have taken provision for tax 2015 balance 70,000 and 2016 balance 1 lakh, and during 2016 60,000 rupees income tax was paid. Now how to treat these transactions? In this case, we need to prepare provision for tax account. We need to prepare ledger account of provision for tax. I think you know rules of debit and credit. Liability will have credit balance. Any transaction increases, liability should be credited. Any transaction reduces, liability should be debited. This is the rules of debit and credit in case of liability. Now, just brought down opening balance. For us, 2015 balance will be opening. As I told, the liability will have credit balance. So opening balance should be brought down on credit side. By balance brought down, opening balance 70,000 and closing balance 1 lakh is closing balance. Closing balance should be carried down on debit side to balance carried down. Closing balance is 1 lakh, and this 60,000 income tax paid. So journal entry provision for tax account debit to cash account, because income tax paid will reduce the liability. So any transaction reduces liability should be debited. So provision for tax account debit to bank account. Income tax paid is 60,000. So this is tax paid during 2016. Now balance the ledger. Debit side we have more excess balance 1,60,000. 1,60,000 minus 70,000. So 90,000. So this 90,000 balance is known as by tax, income tax. So this is current year tax. So this 90,000 is current year provision for tax, and 60,000 is tax paid during current year. In this problem, we do not rate this 70,000 as well as this 1 lakh anywhere in cash flow statement. We need these two information. I mean current year provision for tax and current year income tax paid amount. Now wait to write these two amount. Current year provision is 90,000 and current year income tax paid is 60,000. Okay, this is the format of cash flow statement. I mean cash from operation. Part A statement I have taken. So net profit, to this net profit current year tax should be added. In this example, current year tax will be 90,000. So 90,000 should be added here. That 90,000 should be added to profit. If we add net profit 90,000 to this net profit, we get net profit before tax, and As usual, uh, we will add non-cash and non-operating expenses. Non-operating income will be deducted, non-operating income will be deducted, and we get cash from operation before working capital changes. And to this we will add decrease in current asset and increase in current liability, and we will deduct increase in current asset and decrease in current liability, and we get cash from operating activity. After that, income tax paid during the year should be deducted. In this example, income tax paid is 60,000. 60,000 should be deducted at last, and we get cash from operating activity. So this is regarding treatment of provision for tax. Tax paid should be deducted at last. After deducting tax paid, we get cash from operating activity, net cash from operating activity, and current year provision should be added to profit.